Give us your best advice.
Yeah.
For lack of a better phrase.
No, thanks. I think that the best advice is to stay calm, to be willing to talk to your financial advisor, to be willing to be honest, and to be willing to understand that emotion plays a great part in this.
It really does.
And a lot of people are very smart and they think that they can do it themselves. And my job is not necessarily to tell you that I'm smarter than you, I can do it better than you, or I can beat the market. My job is to listen to you, help you evaluate the goals, and then make sure that we're putting a plan in place that gets you to San Diego on time.
Amen, brother.
In your new Airstream that you invested.
That's Mick Pepper, man, one of my favorite people in this business. He's the managing director for investments over at Virtuant Wealth Management Group. They're part of the Wells Fargo portfolio, and these guys are fantastic.
The very latest on economic development, workforce, and industry sector news in Southern Colorado. Here is Business Digest Weekly with our host, Dirk Hobbs.
Good Friday afternoon, ladies and gentlemen. Welcome to the Business Digest Weekly here on Salem Media, 101.1 FM and AM 1460. Glad you're with us. Of course, you can pick us up on Spotify and iHeart downstream, and of course, the YouTube channel. Just type in Business Digest Radio and you'll find us. So we've got some of the best and brightest thought leaders in various categories from throughout Southeast Colorado coming in and saying hi to us and giving us a little bit of insight. Today is no exception. He's become a good friend of mine, Mick Pepper, Michael Pepper formerly, but anybody who knows him more than a minute will start calling him Mick. Mick, glad you're with us, brother.
Absolutely, glad to be here.
He is managing director over at Virtuant Wealth Management Group, and he's got some great conversations for us to listen to around. You know, we've got a very volatile economy right now. We've got a money system that's up in the air. We've got tariffs. We've got interest rates. We got all kinds of things we can talk about. Now, this is not an advice column, okay? This is not specific advice coming from a financial planner. This is just insights and overview. So I want to put that disclaimer out there. I think you'll probably do it better for me, Mick, here, so we make sure you're clear. But,
thank you. But
you do have a tremendous, because you guys look at this stuff all day long.
Absolutely.
You know, so you know kind of, you've seen history, you've seen, you know, kind of what the president's doing and what the Fed's doing.
Right. We've been here before, and I think you nailed it there. Let's not dodge the fact that this is historic volatility in the markets. And volatility is normal, but it's really big, and it's really changing for people. People are afraid. People are rightfully scared about portfolios and the economy. And so we should put that into perspective that the volatility is historic, but the decisions that people are making sometimes don't coincide with you know, what we're seeing in the markets and that volatility.
Indeed. Well, let's dive right in, because I know our executive audience is like, okay, tell me what you think, man. So let's talk about risk in time and trying to time the tariff turmoil. That's a tongue twister.
Yeah, one of the things that we often get asked or we talk about is how can we play this volatility? What should we be doing in the markets? And what we want to remind people is there's a great risk in trying to time the volatility specific to tariffs, right? And so, rightfully so, I think a lot of people, a day like today or last week is a good example. A lot of people are thinking, boy, if I could just avoid some of these really bad days in the market, maybe it's a great opportunity. Or is there a strategy where I can sit on the sidelines, wait this all out, and get back in when I feel a little bit better?
You bet.
And what we're trying to remind people is there's actually greater risk in trying to make that sale decision, trying to avoid the volatility, avoid losses, than actually sticking with your strategy and staying invested during times like this.
No question.
People think that they're de-risking, but what they've done is actually increase the risk that they're not going to meet those long-term goals.
I have a gut feeling, Mick, and that's all this is a gut feeling, ladies and gentlemen. I mean, like everybody else, we have our crystal balls, but I sense that what the administration is trying to accomplish up there is long overdue, okay? And this is an effort to right the relationships internationally, and kind of just level set the playing field, because we have been upside down for so long. Is that an accurate assessment?
No, I think that there's lots of different opinions. And when we think about tariffs from our side, we think there's probably dueling strategies. There's the short-term negotiation aspect of that. Yep. And then there's the long-term, rebalancing the playing field. When we put those two together, it causes confusion in the markets.
Yep.
And we really need to separate those a little bit and think about what's the short-term impact, what's the long-term impact, but more importantly, what's the impact to me as an individual or my family or my wealth strategy, and they really don't work well together.
Got it. Okay. Well, help us understand, do you think long-term, and this is probably just on everybody's mind, just top of mind, just your individual opinion about it, is China in this spot that the administration is claiming they're in? I mean, they're backed into a corner a bit here.
I think so. Here's the problem, is that I think that our ability as Americans to play the long game is paled in comparison to China's ability to play the long game.
They think in thousands of years. We think in minutes.
Minutes is right. Like how many? Like I think I checked my portfolio on the drive over here today, and so we're capitalists, and we want to know now. We used to look at companies that would report earnings yearly and look for the future. Then we made them do it quarterly, and now we want to comment every day on how they're adjusting. And so I think that that's really difficult for our society to digest and to understand that it just works a little bit different over there. I'm not a political scientist,
right?
But I understand how the markets react to that. And I think that it causes confusion, number one. And I think it's uncertainty that leads to volatility. And then all of that wrapped in together, we get in a firestorm. And it's just really, it's what do you do? What do you do? What do you do?
Yeah.
And our advice is sometimes it's step back and reevaluate what your long-term goals are. Mm-hmm. And more importantly, for me specifically, what's your time horizon?
Right.
If we're talking about 10, 15 years, and going back to the tariff things, is if we're trying to fix something 10, 20 years out, understand that's the goal, and we may break stuff in the short term.
Yep.
And for investing, if your time horizon is long-term, understanding that some of the decisions that you're making now are probably on the downside, you're going to break something in the short term too.
Oh, man. Mick, I'm glad you're here, man.
I'm glad to be here.
These choppy markets we've been having, we believe we're staying invested and can be more beneficial than selling into volatile markets trying to avoid losses. Explain that to me a little bit.
I think that what it really comes down to, simply put, is by missing just a handful of some of the best days in the market, just a handful, miss those best days, you drastically reduce your ability to hit long-term goals. Okay. So let's put some numbers to it, right?
Yep.
So if we look at the S&P 500 over the last 30 years, it annualizes about 8%. If you miss just 5 or 10 of those best days over those 30 years, just 10 days over 30 years, you drop down to an annualization of 5.5%.
No kidding.
Right? And I'm going to look at the numbers so I get them exactly right for you. if you miss 20 days, Dirk, just 20 days over the 30-year time frame, 3.3%.
Really?
If you miss 30 days over the 30 days, you just missed the best 30 days, 1.7%. If you miss the best 40 days, it's 0.3. And if you miss the best 50 days over 30 years, if you miss 50 days of trading, you just were going to sit on the sidelines, you have a negative 1% return annualized over the 30 years.
Wow.
So the lesson there is, in trying to avoid the worst down days, you miss the best up days, and historically it leads to worse outcomes. And the problem really lies in the fact that it's easy to make the decision to get out.
To unplug.
It feels good. It makes the decision.
Yeah.
But we want to remind people it's only half the equation. So you have to be willing to make the decision to get back in. We're historically bad about it. It's easy to make the decision to get out. It's so much harder to make that decision to get back in. So think about this. So on the tariffs were announced April 3rd, right? And the market the next day drops like 5%. It's like $2.5 trillion in value. It's shocking. It's the worst day since COVID.
Right.
Right? 7 days later, the administration says, let's pause. Right? We're going to go ahead and pause here.
Yeah.
And the market jumps 9.5% within 7 days. It's the best trading day since 1950.
Yeah.
Right?
Yes.
It's outrageous. So if you were smart enough to say, hey, I'm out of it. Yeah. March was terrible. We were down 5%. I just want to sit on the sidelines. If you were smart enough to make that decision on April 2nd, you had 7 days to change your mind, to get back into the market before one of the best days since 1950.
That's
7 days. And during those 7 days, you just felt terrible because the news was telling you the markets are crashing. We're heading for a recession. Things are terrible. And they might be, but you had 7 days and you missed that best day. Mm-hmm. And so that's just tough for people. So the other lesson is sometimes the good days and the bad days are clustered so close together, it's hard to time it.
Yep.
So we understand the idea or the strategy of, I just want to feel better. I just want to sit it out. I mean, it's natural.
Yeah.
I mean, this is historic volatility. We understand that. But we have to educate people and help remind them that by trying to time that, you're increasing risk and you're most likely not going to meet those long-term goals.
And I'm sure in the back of your mind somewhere, you're probably sitting across from those folks and you know they're panicked. You know they're strung out. Some of them are retiring on this stuff, right?
Yes.
I mean, and it's their retirement. It's not going to be their grandkids.
Absolutely. You bring up a good point there. Like if someone's calling in and they're concerned and like, Mick, I was so close to retirement, or I was so close to sending my kid to college, or I was so close to buying that vacation home I've been saving for in Costa Rica. We have to subtly remind people that, well, if your time horizon was that short, your risk profile was probably mismatched.
Yeah.
You probably shouldn't have been taking those risks. On the flip side, if you can get everybody to understand, or if we can educate the investing public, that if your time horizon is 10, 15, 20 years out, if I'm investing for my grandkids' education, I'm investing for my retirement income or my dream home somewhere else, and if the time horizon's long, then we can stick to the strategy, and you're probably going to miss some of those days. And when you miss those days, it comes when you're not thinking about it. So think about this one here. Some of the best days that we have over the past 30 years have happened during bear markets. Mm-hmm. And some of the best days that we've had, or the worst days, have been in bull markets. But go to the best days, because that's what I want to focus on here. It's missing those best days. The 10 best days in the last 30 years all happened during recessions. All of them. 6 of those 10 happened during bear markets. 3 happened in 2020, and the other 7 happened during the Great Recession. How excited were you about investing post-COVID?
Right.
Or during the Great Recession.
Sure.
But you missed those days, right? And so what we really want to do, what I think that how we should educate is to take a look at the time horizon and understanding that timing's really difficult and don't sell into the panic, right? Mm-hmm. But I know what the next question is. Or for clients. Well, Mick, does that mean bury my head in the sand?
So let me stop you there.
Yeah, absolutely.
And we'll come back. That's the good Mick Pepper. He is managing partner here, or managing director for investments at Virtuent Wealth Management Group. You can find these articles in the Business Digest and also in North Magazine if you're up for it, because these guys know what they're doing, folks. Ladies and gentlemen, these are some of my favorite people to hang out with because you do get a great education. Stick with us. We're back in a minute with Mick Pepper.
My experience with Colorado Springs Orthopedic Group has been top-notch. The whole orthopedic group, they've worked very well together. When I've gone through PT or needed to get my collar prosthetic, everybody's been just right on top of it. It's all centralized and the communications have been awesome. Even though I had my nervousness about going into surgery, I was still very confident. I knew I was going to be okay. Colorado Springs Orthopedic Group is definitely getting me back to my life and the things that I want to do.
So let go.
All right, we're back here, second quarter Business Digest Weekly on a Friday afternoon. Glad you're with us. Michael Pepper, a.k.a. Mick Pepper, is across the board from me, and he is the Managing Director for Investments over at the Virtuent Wealth Management Group. These guys are spectacular. We've had a partner of his in here, T.H. Williams, was talking about cash and currency here not long ago. You can go see that interview. Still relevant stuff. Absolutely fantastic. Insights and understanding as to how the American dollar fits in the global economy. It's absolutely good stuff. So, Mick, glad you're here, man.
Yeah, glad to be here. And I think that TH's podcast was really inspiring for me, and it's really relevant now, and it should be revisited because it's a fantastic piece.
When you hear the pundits talk, you think the dollar's just going away.
Yep, absolutely, and not necessarily true, right? And
that's right.
And TH brings a lot of facts and puts it into perspective of what's really happening. I mean, the dollar is getting pounded, right?
Yep.
And it's a little bit in trouble, but I don't think that we're at any risk of U.S. exceptionalism, and even with the dollar, because there's really no viable alternative.
Right. Not today.
Yep, not today.
Certainly not today. Well, you left us with a little cliffhanger in the last one there, so let's pick up where we left off.
Yeah, it's easy for me to sit here and say, hey, just stay invested, right? Because it feels really, really bad. And that doesn't mean don't take action. It doesn't mean bury your head in the sand. I think that volatility brings opportunity. And realistically, it's some of the things that we learned at the very beginning of our investment education. It's really probably a good time to rebalance.
Okay.
Right? Rebalance into your portfolio. Kind of the portions of your portfolio that were doing poorly, now you can rebalance and buy into that, or the things that were doing well, sell, but basic rebalancing. The second thing is really take a look at how diversified you are, because in these situations, diversification really works. And it can be diversification across a lot of different things. Asset classes, think stocks, bonds, commodities, cash. Am I diversified across the board there? It could be style, large cap, small cap, mid cap, emerging market, international, whatever, right? It could be sectors. Do I have coverage in energy, consumer discretionary, healthcare? Making sure I'm diversified across the board, right? So I think that's the second thing. And then the third thing is to remind yourself to be patient and reevaluate your goals. Right. So I thought about it as this is kind of like what we would learn in college about this. For your grad level, the next step, the other opportunity is probably to consider alts. We've talked a lot about how alts really for qualified investors, it's not for everybody.
Not for everybody.
Really provides an opportunity. It's kind of the fourth step there, because you can introduce a non-correlated source of return, and the whole objective there is to kind of dampen that volatility a little bit. For people that are invested with a healthy share of alternatives in their portfolio, the experience that you're seeing on TV is not necessarily the experience that they get in their portfolios.
Interesting.
And it's just because it's non-correlated. Doesn't mean it's always positive. Doesn't mean it goes down when everything goes up or up and down. It just means it works in its own world. So so those are the things that we would encourage people to do, to take a look and rebalance and talk to your financial advisor. Make sure you're focused on your long-term goals. Make sure you're diversified. Up that diversification, and don't panic. Be patient.
Be patient. Business owners.
Yeah.
A lot of folks are just reeling in the spends everywhere.
Yeah.
Right. And we're just kind of battening down the hatches and riding out the storm. Obviously, there's prudence in that. From your chair, what are some indications that the storm might be clearing a little bit?
Yeah. So I'm not an economist, but I read. We've got some great economists at the Wells Fargo Investment Institute. And while we think things are weakening, that doesn't necessarily mean that recession's on the horizon. Doesn't mean it's not. I think we're closer to a 50-50 if you polled everybody that about 50-50. But just because we don't head into recession doesn't mean that specific industries or specific small businesses shouldn't be afraid, right? So if you look at it from a global aspect or the United States, everything's fine until your neighbor is out of business.
That's right.
And so that's really tough to understand. So we have to also take a look at the local economy, take a look at the local markets, and kind of what's your specific situation, give advice that way. So it's really specific to the individual. The global headwinds are there. We think that we'll come out of them okay, but for the specific small business owner, it's kind of like take a look at your market, and then same thing. Where can you be nimble? Where can you make some small adjustments, and do you have the right long-term strategy, and are you willing to stick it out?
And indeed. So you're a local guy.
Yes.
You know this market. You know that aerospace and defense, advanced manufacturing, cybersecurity are big parts of our economy, sports economy, hospitality. Any words of wisdom that you care to share, and in terms of what you see and how that macro system might trickle down?
Yeah, I think that we're in an environment where we're going to see the biggest rapid change driven by AI that we've in our lifetimes that we've experienced. We didn't experience the Industrial Revolution. We got to experience the invention of the internet and it kind of changed our world, but it changed it over a 5, 10, 15-year time frame. We believe that AI is going to change it in the blink of an eye.
Wow.
And so, we make the joke that if you live 5 years, you might live forever.
Okay.
Right? Type of, and I don't know how realistic that is, but the analogy works, right? Like if you make it 5 more years, you might be able to live forever. We think that technology is going to change the world. And in our industry here and in Colorado Springs, we're really well positioned to take advantage of that. The industries that drive our city, are going to be the ones that perform. It might look a little different, but they're going to perform.
How would you recommend clients work with their advisors, whether it's Virtuant or elsewhere? How frequently should we be in contact?
Yeah, number one, I think it's whatever your comfort level is. Mm-hmm. We like to make sure that we're talking to you 4 times a year.
Okay.
All right. Once a year, we really need to sit down, reestablish goals, do a check. But the rest of the time, it's more like a touch base, a pulse check. But on the flip side, we try and be open to say, as often as you need to talk to us, because half of our job is really talking. It's really working through these and reminding everybody what the situation is. When that part's done, I go to work, Megan goes to work, TH goes to work, we do our job. But sometimes it's just having that conversation, right? Don't be afraid to reach out to your financial advisor. I wouldn't wait for them to call you because, they're probably
pretty
juggling different balls, right? We got to build, for us specifically, we build our own portfolio. So we're doing the portfolio management. We're evaluating risk. But really, at the end of the day, it all starts with a good plan. So there's the big advice. Make sure that you start with the plan. You start with, what's my financial plan? What are my goals, objectives? For me, I keep hammering it. Time horizon, like how far do I have to go? When's the end game? And does today really matter type of deal? So that's it. I'd reach out,
a couple times a year,
a couple times a year, and just talk and just what's changed, and then talk about the feelings and to get reminded. Sometimes you throw the data out there on everything you see on TV looks terrible, but is that the real experience that you're having?
Okay,
and level set it a little bit.
Yeah. Economic and financial literacy is a big deal.
Yeah.
Talk about an ideal Virtuant client. What's your sweet spot as an agency?
Yeah, absolutely. I think that we want to get to the level where we're working with people that have complicated situations, right? For many investors, once you get the plan and once you get the savings down, then we can work with that. But for others, it's really, do you have complicated issues? Are those concentrated stock positions? Am I getting ready to sell a business? Do I have a large capital gain? I need capital now, but I don't want to pay the taxes. Wills, trusts, estates, and how that all works into what we do on our side. We don't write, wills and stuff, but we want to advise and work with that. But then we can get to work there. So our ideal client is probably someone that's getting ready to retire, getting ready to sell their business, has a complicated issue, whether they need to borrow money, they need access to capital, and then we dig in and figure out the best way to make it efficient, not only with taxes, but with your time and deliver good outcomes.
Absolutely. Well, how do they get in touch with you, Mick?
Yep. So multiple ways. So, virtualwealthmanagement.com is where we can go there. That's probably the best way.
Easily.
We have our 1-800 number. We've got a great team. I've got 4 partners. I've got, we've got some of the best associates in the business. We've got a chief operating officer. We call him the Wolf. And so we've got a team here built to try and do that. So you can call that number. We're going to get you with the right person. If you're in Colorado Springs, you can come down and see me. I'm down in Colorado Springs every day. So.
It's worth the trip.
Absolutely.
So Mick Pepper, he is Managing Director for Investments at Virtuent Wealth Management Group. And these guys are a lot of fun, very knowledgeable group. And we're going to come back, some of you small business owners as well as you individual folks, and we're going to get a better read on things you learned in kindergarten. Now, we talked about complex, but we're going to go back to kindergarten for a minute and try to tie that together with some of the things Mick wants you to walk away with today. And, of course, just understanding how to evaluate your goals and objectives in your financial portfolio. So stick around. We're back in a moment with Mick Pepper, Virtuent Wealth Management Group. All right, we're back here, second half, Business Digest Weekly on a Friday afternoon, only 90 short minutes away from your first cold toddy. And I would recommend spending that time with your financial advisor. Why not? Get a bead on what's going on out there. There's all this volatility, all this noise. And if you watch any of the pundits on television, you're going to walk away depressed. But why not walk away with a plan, empowered with some intelligence and insights, with people who are watching this thing for the long game as well as the short game, and try to get your compass balanced here, because this is an unprecedented time in the U.S. economy right now. We're fixing a lot of old traits and trends, and hopefully we're going to end up on the positive side. I know I hear that hope word a lot out there, Mick, but glad you're with us, friend. Thanks for coming in.
I want to remind you that hope is not a strategy.
It's not a strategy, but I hear it a lot.
I hear it a lot too, and I think that it makes you feel good.
Yeah, sure.
And that's important to
silver lining.
Good about it. Silver lining there, yeah. But at the end of the day, you still need to do the work.
Yeah,
right. You still need to have that plan, and you need to revisit that plan again and again. And sometimes you have to go back to the basics.
Yes,
right. And so I talked about it a little bit before, but let's revisit each one. Right. So. The first thing is remembering there's an opportunity to rebalance your portfolio. In times that are great, we see the equity portion of your portfolio run, and then it takes you into a different risk profile, right? And so it's a good opportunity when volatility hits to reevaluate that and see, does my portfolio still really meet or match what my strategic target is? Because when things perform or go bad, it's an opportunity to rebalance and shift towards that risk profile that you've set for yourself.
Got it.
So rebalancing is really important. It's an opportunity to take a little bit off the top in equities, buy some fixed income, or buy some commodities, but make sure that you have that plan set in place before, and then let's go ahead and make some changes there. So rebalancing, we forget. We really forget to do it in our 401k.
That's right. Yes.
It's set it and forget it, which is part of the beauty of a 401k.
Yes.
Is the money out of sight, out of mind. My uncle once told me that it doesn't matter where you're at on the income level, you spend what you make. And so if that money's out of sight, out of mind, you're saving it, but you still should revisit it. I don't think you should trade it. I don't think you should be looking to time it. Just rebalance every now and then. I think you'll be better off.
Of course, diversification.
That's the big one for me, right? Diversification really works. During what we saw with the Mag 7, people thought, if I just have the S&P 500, things are going to be great. But 7 of those stocks drove 80% of the performance in 2020 and 60% of the performance after that and 30% of the performance. And if you weren't diversified, now you're in a position where, let's just use NVIDIA as an example, the big name in the Mag 7.
Yep.
Well, all of a sudden you think you're diversified, but if the majority of your performance is driven by one stock, and then that stock gets hit during volatility times like this, you're in big trouble.
You're upside down.
Right? You're upside down. So taking a look and make sure you're diversified across the board, because what it really brings you is a volatility damper. Right? It moves it down a little bit. Same thing with sectors and trying to understand where in the industry, what has been beaten up. So whether that's energy was doing great, now it's not doing so well, or looking forward, consumer discretionary, people had money to spend, but now we're going to move back to staples. finding an opportunity to make sure that in your portfolios, you're covered across that a little bit. And maybe you're overweight the ones that your financial advisor thinks are going to perform better during a down market or a potential recession. And maybe we're going to take a little bit off the table for the ones that we think are going to struggle during this time frame.
Got it.
Right. So that's that. The last one in the kindergarten level, it's really college level. I just remember that whole quote of everything I needed to know I learned in kindergarten.
That's right.
And so sometimes with investing, it just goes back to what we learned there. Be patient.
Yeah.
Right. Patience is a virtue here, and it gives you the opportunity to make sure that we're focused on the goals and the outcome. Right. So patience is important.
It's in short supply.
Yeah, absolutely.
In the United States, because we're instant gratification culture.
Yep, absolutely. And so my advice at the beginning was don't try and trade the volatility into tariffs. Yeah. But that doesn't mean do nothing. It's probably a good opportunity. And by the way, it's a great time to meet your advisor for happy hour on a Friday afternoon. Because you can be in a relaxed setting and focus on the goals and not so much on what's going on on the TV.
So before we go to alts, I want to ask you, where can the average bear get a better economic and financial education?
Yeah.
Now that you're an adult and you got a busy life.
Yeah.
And you're just throwing money at the wall.
So it's interesting. There's so many podcasts. People they yearn for information. So listen to That Works. But I think that let's use Wells Fargo, for instance, right? You can have a pretty good education in there by just subscribing to the Investment Institute and listening to some of those experts talk at different levels and figure out how that applies to you. Okay. Right. So, but we don't just use Wells Fargo, right? We like to listen to the advice of larger firms like JP Morgan Chase or Goldman Sachs or and so finding a different view is important. And then this is where talking to your financial advisor works. I listened to this podcast. I read what Dr. Williams said over here, and I listened to what Mick Pepper said over here. But how do we put it all together, and more importantly, how does it apply to you specifically?
Right. So. Very good. All right. Well, let's pivot and get into those alts and unpack that for us, because for the layman that may not be familiar territory.
So you're probably, if you're listening to the podcast, you're probably hearing a big push towards alts. And what does alt really mean? We mean an alternative to traditional asset classes, those ones I talked about before. Traditional asset classes, equity, stocks in a company, fixed income, bonds, so ownership in a company or lending to a company, commodities, think of soybean futures, corn, oil, gold, a commodity, a real asset, right? And then cash. Those are the traditional four asset classes.
Right.
An alternative is anything that is not one of those. Right. So for us, alternatives fall into a bunch of different buckets: private equity and private debt, private real estate, and hedge funds. Yeah. Right. Those things. People hear the word hedge fund, they don't understand what that really means, but they all work in a little different area. I sit in a beautiful office in downtown Colorado Springs. And when my clients are there, we kind of turn around and we can see Pikes Peak. I can see Garden of the Gods. It's really beautiful. And I have them look out and say, when you look out my window, 85% of what you see is in the private sector. But if I turn this way and CNBC or Fox Business or whatever you're watching for your business news is on there, you think that the entire economy is driven by what's on the blinking screen behind you. And it's just not true.
That's correct.
85% is driven by private markets. Most investors don't have access to those markets, but qualified investors do. And so finding a way to move into the private markets gives you a non-correlated source of return. And that's what we're really looking for, is something that's non-correlated to the noise that we hear every day in the regular markets. People are focused on what the S&P 500 did today, and the S&P 500 has less to do with your life than you think it does, but as an investor, it probably has way too much impact. So how can we get involved in private markets? So private equity or private debt. Those are two areas that really work for people in increasing their income. The other option is infrastructure. Right. So when you think of infrastructure, it's a great hedge against inflation. Right. We're talking about power plants, bridges, railroads. It's an opportunity to reduce volatility, have a buffer against inflation. That doesn't mean it always works. It just means that it's not correlated to what you see in the markets, right? And so that's where we think alts, are important. But here's the caveat: alts aren't for everybody, right? So for the majority of investors, you have to be a qualified investor. You have to be able.
What is that today?
So I think that what you really need is a little. I don't know how the exact specifics because it changes, but think of I've got over $1 million in liquid net worth, or I'm a high earner and I have the ability to prove that over time. For institutions, it's bigger. You have to have $10 million or so in liquid net worth, but you have to be sophisticated. But but it leads to this. You have to be willing to not only accept the risk, but you need to be able to take the risk. And you have to understand that liquidity is a factor.
Yeah.
Because when you get into the alternative world, liquidity is the number one factor. Right now, we're at trade +1 on sale of stock. You want to sell a stock, I'll sell it today, it settles tomorrow. I mean, it's really liquid. Fixed income is really rather liquid. Yeah. Private equity and alts aren't. Think about your house. Your house is not liquid, right? You might want to sell it. You might be forced to sell it. But even if you want to do a fire sale, it's going to take you 30 days to get that done.
Yeah.
For alts, really liquidity could be I'm holding it for 10 years. Or it could be, these semi-liquid alts that we're trying to use now, integral funds, really, where we have liquidity opportunities once a quarter.
Copy that.
But liquidity is a big factor there.
Indeed it is. All right, when we come back, we're going to talk about how to sit down and have an honest conversation with your advisor and how to start evaluating your goals and objectives for your financial future. I'm hanging out with Mick Pepper. He is the Managing Director for Investments at Virtuent Wealth Management Group. We're back in a moment.
My experience with Colorado Springs Orthopedic Group has been top-notch. The whole orthopedic group, they've worked very well together. Even when I've gone through PT or needed to get my collar prosthetic, everybody's been just right on top of it. It's all centralized and the communications have been awesome. Even though I had my nervousness about going into surgery, I was still very confident. I knew I was going to be okay. Colorado Springs Orthopedic Group is definitely getting me back to my life and the things that I want to do.
See the change in my face now, 'cause I'm finally waking up, so I let go.
All right, fourth quarter here, hanging out, getting a great financial and investment education with Mick Pepper. He is the Managing Director of Investments over at Virtuent Wealth Management Group. They're here in Colorado Springs. They're in Denver. They're throughout the Front Range. Great team. We had T.H. Williams here a couple of weeks ago. He was talking about currencies and where the U.S. dollar fits in the general equation here. And, if you listen to the pundits, ladies and gentlemen, you'd think we're out of business. We're not out of business. I would encourage you to go back on our YouTube channel or Spotify channels and listen to that interview with T.H. It's Dr. T.H. Williams, mind you. He has earned it. This is a great insights and understanding of how our capital systems work here in the United States and on a global stage. But for the time being, we're hanging out with Mick Pepper, and he's helping us understand these volatile waters we're in right now. And I got to tell you, folks, I kind of like what's happening out there. I like the shakeup a little bit. Conventional wisdom was just kind of getting us through day to day, and we had a lot of uncertainty with the former administration. The current administration, of course, lots of uncertainty as well about a great many things. But what I think we're doing, at least intuitively, I think we're doing the right thing, and we're trying to reset those tariff discussions and create an equal playing field for all nations, including our own, because we have done a lot of selling out over the past several decades in presidencies, that's for sure. All right, let's get back to business here. When you're having, like I said, you're an hour and 15 minutes away now from your first cold toddy. So when you have that cold toddy, maybe invite your financial planner out and talk about what you're doing. Does it make sense? Do we need to pivot? Do we need to move? Do we need to pull the plug it back in, stay put, whatever? Those are individual discussions you have with your counselors. And what I would like the audience to walk away with today is a few pearls of wisdom, some questions that you want to ask your financial planner and advisor, and what they should be asking you. Mick, you guys are really good at this.
Yeah, thanks, Dirk. Sometimes you go into your meeting and you immediately want to jump to performance, or
outcomes,
outcomes and what's going on there, or we want to talk about the numbers, and we forget, or Mick, what are you buying, or what are you selling? And we tend to forget that without the foundation of a solid plan and understanding what are we investing for, what is the goal?
Love that question.
That's another thing. And so I think that heading into your meeting, if you can set the other parts aside, they're important.
Yes.
At the end of the day, performance is important.
Of course.
But you can't get there without understanding what you're trying to achieve, what you're trying to accomplish.
Okay.
So when you meet with your financial advisor, sit down and be honest and be willing to talk about what am I investing for? It can be different for everybody. Some people are investing for the ability to live the life that they want to and that they deserve in retirement. And you need income to do that. And that's, I would say, the number one objective out there is I need to be able to, I've worked and worked and worked, and now I'm ready to retire. And do I have enough assets to live the life I want to live in the manner that I want to live it? And will I be able to sustain that as we potentially live forever? Right? So that's it. So being honest and having that conversation about this is what it looks like in my mind. And then working with a tool and understanding, okay, if that's where the end destination is, now let's back and figure out where are we at today? And are we honest about whether or not we're making the right decisions today to get us there? And then we'll worry about the changes along the way, right? So anytime you take a journey, things happen. If we're using the travel analogy, I know that I want to get to San Diego. I'm going to drive to San Diego. When I have a plan, I know how long it's supposed to get there, but I got a flat tire, or there was construction, or a storm came through. And so we can deal with those, but we need to figure out what's my likelihood that I'm going to get to San Diego on time. And then we use different tools to say, what's my propensity to succeed? What are the odds I'm going to go? Because it's not always going to work out. We have to be honest about those when we think about retirement. Or maybe I'm investing for the next generation. I want to set my kids and my grandkids up so that they start with a solid foundation. I worked and worked and worked, and I want them to work and work and work, but I want to go ahead and set their foundation. What's the goal? What am I investing for? Goals can be different. Some people have goals that I want to buy a Winnebago. I want to buy an Airstream.
Yeah.
Right?
Yeah.
And I want to be able to have my house done, but I need to make enough money so that I've got a discretionary investment of $250,000. Airstreams are expensive, right?
Yes, they are.
And so does it fit with my plan? That's okay, but understand what the goal is. Then we can back into, are we making the right decisions today to get there? And are we taking into account that it's not always going to be straight up?
I appreciate the visual metaphor of the trip to San Diego, but sometimes you're sitting in front of a couple or an individual who's mid-50s, 60 years old. They're in panic mode, Mick, because of what's going on today, but maybe some of the bad decisions or indecisions that they made a while ago. You guys are part counselor, part friend, part, advisor, all that good stuff. So how do you get them out of the tree?
Yeah. So it goes back to the honesty portion. They have to be honest with themselves.
Yeah.
And you need to be honest with your financial advisor. It's common for clients to come in and they feel embarrassed.
Yeah.
Right? Like,
they want to,
I'm just not, Mick, you probably work with, millionaires and this and that, and we do.
Yes.
But that doesn't mean that your money is embarrassed money. My previous partner used to have this jar at the back of his office, and it was called the embarrassed money jar. And he says, if you're really embarrassed and you don't want, you can deposit it in that jar at any time that you want, right? I'll take it, right? So it is what it is. It's what you've had. But what's more important is, what does retirement look like for you? And we need to know today if we're prepared to live that and be honest about the outcome. I think a lot of people think, oh boy, I'm going to be just fine, and when you do the math and you say, how much money do you think that you're going to need in retirement? Set a budget. Megan does a great job of really trying to say, what's your monthly or yearly expenditure in your mind today? And then we'll use math. It's, to extrapolate.
Pretty consistent.
Yeah. Can you do that realistically? And then can you do that in bad markets? Can you do that in good markets? And do we have the right play there? So being honest is the key there of what do I really have? What does it look like? And then how can I make that or get me closer to that reality? That's
and you guys have you have a requirement basically in saying, all right, so from where I'm sitting today, what you're saying, what your goal is, and the number that you're giving me for retirement, that math doesn't add today.
Yeah.
Okay.
So one of the things is we're really not going to probably work with a client that doesn't want to put the work in on the planning side.
Copy that.
We're not a shop where someone is like, hey, Mick, do you have great returns and are you the best investor in the world? And what you're trying to accomplish is different than every single one of our other clients, right? And they're just looking for the hot dot. They're looking for the opportunity to get the best performance, and that's great. I hope you get it. We're not that shop. What we want to do is plan for outcomes, risk management, wealth management, complex situations.
You ask an important question here. What is the risk of not achieving the goal?
Yeah. So people think about the risks. People think that risks are down markets or one of the biggest risks is I'm going to invest here and the market's going to go down and I'm going to lose some of that money. And that's one risk.
Yep.
So Mick, wouldn't it be better if I just took my money and put it in under the mattress? And they don't understand that.
Ouch.
That's probably more risky than risking it in different financial markets. They don't think about risks of inflation, right? And so what I talk about here is the risk of what does it look like if you don't meet that goal? So this goes to the timing question. You're introducing risks that you're going to have poor outcomes or lesser outcomes, and you're not evaluating that risk. You're only evaluating the risk that's today, but you're not evaluating what's the long-term risk if I'm not following the plan and the strategy. And so risk can be defined as a lot of different things. We need to talk about all the risks associated, not just what the volatility and market risk is today, tomorrow, this month, this year.
Right. You got about a minute left here.
Yeah.
Give us your best advice.
Yeah.
For lack of a better phrase.
No, thanks. I think that the best advice is to stay calm, to be willing to talk to your financial advisor, to be willing to be honest, and to be willing to understand that emotion plays a great part in this.
It really does.
And a lot of people are very smart and they think that they can do it themselves. And my job is not necessarily to tell you that I'm smarter than you, I can do it better than you, or I can beat the market. My job is to listen to you, help you evaluate the goals, and then make sure that we're putting a plan in place that gets you to San Diego on time.
Amen, brother.
In your new Airstream that you invested for.
That's Mick Pepper, man. One of my favorite people in this business. He's the managing director for investments over at Virtuent Wealth Management Group. They're a part of the Wells Fargo portfolio, and these guys are fantastic. They're friendly. They're honest. I really enjoy hanging out with you guys because
thanks for the invite.
I've never felt the sales stuff with you guys. I've always felt like you're really having fun and enjoying the relationship aspect.
Yeah, I think the relationship is really important, and understanding trust. You want to have that relationship with your CPA, with your attorney, and your doctor, and your financial advisor. The four most important, people in your planning process.
Outside your wife.
Well,
or spouse.
the most important.
That's right. Mick Pepper, thanks for being here.
Hey, thanks for the invite. I
really appreciate it. Folks, have a great weekend here in Southern Colorado. We'll see you next week.
You've been tuned in to Business Digest Weekly with Dirk Hobbs. If you'd like to be considered for a spot on our show, email us at info@coloradomediagroup.com.